Stocks have been rallying since that horrific August. We were just back to the top end of our trading range, but now we have a chance after this turnaround today to really get above the highs. The major average is still only showing a slight gain for the year, but it's better than a loss. How do investors achieve bigger gains? Joining us now is Joel Greenblatt, Managing Principal of hedge fund Gotham Asset Management and author of the new edition of the New York Times bestseller, The Little Book That Still Beats the Markets. The latest edition goes on sale today. Joel, thanks for coming in. Is it Graham and Dodd mostly, or is there more to it?
Well, I explain a way to take advantage of some of the concepts that Graham and Dodd talked about 70 years ago, which really are buying companies that are cheap. So we look at companies that earn a lot. We try to buy companies that are selling cheap relative to the amount of earnings that they have. But one twist that Warren Buffett put on what Graham and Dodd did was said, well, it's nice to buy something that's cheap, but it's also good to buy something that's in a good business. So buying good companies at cheap prices is really what we're looking at when I put together the formula for this book.
Because, when you can say still beats the market, but that doesn't necessarily mean that buy hold is going to be a great strategy, because you could have beaten the market over the last 10 or 11 years and gotten, 1% a year would have beat the market, right?
I think that's a really great point. We in our back tests, if we had followed this formula over the last 10 years, the decade of the 2000s, the market was actually down about 1% a year.
Yeah.
Following this was up about 13.5% a year during that period.
That's huge.
You're right. But the reason it really works is that it doesn't always work. It's really not that great a formula. In other words, there was a period during that great 10 years, right? You beat the market by over 14% a year.
Yeah.
So you more than tripled your money during that 10 years. But at the same time, there was a 34-month period and a non-overlapping 13-month period where you underperformed the market. So most people quit on a formula, especially a formula, or just any strategy that's not working. Most people just chase whatever did well last year. And so you can't really do that as a value investor. It doesn't always work. You could last a long time not beating the market.
So if we started running screens based on this formula, what stocks would show up today as buys?
Right, I don't want to mention specific stocks, but the areas would be there's a lot of retail stocks that show up, construction and engineering firms, there's a lot of pharmaceutical companies, a few of the interesting for-profit education companies come up. And the bottom line is that you buy a package of these. It's almost like an insurance bet where you buy 20 or 30 of these companies, and they're all out of favor. In other words, they're cheap because something's... if you read the paper, you wouldn't buy any of them because you know that there's something wrong, but you're getting them cheap. That's already reflected in the price. But you're buying companies that earn high returns on capital, which is very important, and you're buying them at very cheap prices. And even over those 10 years where you tripled your money, only 50 to 60% of the companies that you chose actually did beat the market.
We're at this moment where I see it's like 1/3 of the S&P 500 is yielding more than the 10-year. And yet, clearly, people are choosing to buy the 10-year. The only reason you would make that choice is if you think the yield on those S&P stocks is going to go even higher and you're going to lose on your principal. What do you say about this moment in time, which is a big reversal of what we've seen over the last 50 years of history?
Well, it's a great question. We have a lot of data. We've done tons of research over the last period of years that ended up coming out in the book originally in 2005, and then we've dedicated a lot of resources to looking at this. And so we can put together a value portfolio now that's pretty much in the 85th or 90th percentile of cheap if you put together a value portfolio. Now looking forward, and that's cheap based on trailing earnings and cash flows, the way we measure them. So it could be that we're in a pretty bad decile looking forward. In other words, next year may be in the 15th percentile and prices are appropriately priced, but I think that there's a lot reflected in current prices, especially for a large amount of value stocks, including some of the large, well-known names that you're talking about, that offer great opportunity historically.
What percentage of your own portfolio do you have allocated against the strategy, if you will?
Well, we have a number of different strategies we follow. Some are just straight long, some are long and short, and out of my liquid assets, probably about 80% are really now in quantitative strategies similar to what we follow in the book.
How much between 82, let's say the market lows in 81, so 800, just call it, between 82 and 90, did it underperform the overall market? And then, let's say in the 90s with the tech bubble, did it with value, does it not catch the go-go years as much as the overall market?
It's a great question. I mean, value investing has been tested way back. You know, it's worked for 50 or 60 years. It's still hard to do because it doesn't always work. Our database for this, you know, the robustness that we needed in the database only went back to 87. So we have now 23 years of history to show how well this does. And, you know, over that time, it's pretty much doubled the market's returns.
Really?
Yes.
I mean, I think you know, what's the old saying? Please let it happen one more time, because I've blown all the money from the last. But was it 94, 95, 96, or 95, 90, 35% plus each year? It was there for the 35?
Yeah, it actually it did
better.
incredibly. Yeah, it did incredibly well. It's just the reason why. If I'm writing a whole book about, you know, with a formula that tells, you know, everyone would follow it if it was perfect. And there are years where it doesn't work. And that's when people stop following it. And it's hard to do because if you look at the list of companies that it tells you to buy, you read the paper, you say, I don't want to buy any of these things. You know, why am I going to buy a for-profit education? And some of them don't work. But on average, they do because you're not paying a lot for any of them. And the ones that work out quite well. You know, you know, we've worked on all kinds of, over the last years through our research, institutional strategies that we're rolling out now. And, you know, all our studies say that it's a very robust way to beat the market. It's just tough to do sometimes.
And when you say, if you read the papers, you could put in, if you watch CNBC. It'd be the same.
I could,
sort
but
of interchangeable. I know you're saying read the paper, but I think of the not-for-profit.
You got to get with the times. You got to say now.
No, I don't want him to say that about it because it sounds like we're contrarian. But basically, if it's in the media and you're reading about it and there's headline risk, then it's probably a good time because that's usually the opposite eventually happens. Right?
I'll be more discreet and just say thanks.
Especially when you're on next time.
The next time, can you say, instead of if you're reading it in the newspaper, you can say if you're reading it in the New York Times, would you just put that in?
I will certainly do that.
All right,
Thank you. There you go.